And on today's show, Frozen Defined Benefit Plan Opportunities, part 2 of this week's series on defined benefit terminations and structured settlements with industry expert Steve Pilger. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Innsmouth. Let's get down to business. Well, welcome, Steve, to day 2.
How about that?
I got to tell you,
thanks for having me back.
I'm happy to have you back because you're introducing our advisors not only to, for most of us, I would say this would be a new area. Mm-hmm. Structured settlements, we've heard about that before, but now this whole issue of frozen defined benefit plans and the opportunities. If you missed yesterday's show, I just exhort you to hop out to our site, downtobusiness.brokerage.com, and look at that show because it'll kind of give you a foundation of what we're talking about today. Steve, let's look at this because I'm looking at some of the 3,000 plans. I mean, we're not talking about everything. We're just talking about 3,000 plans that hold this small area according to this date. Tell me about the size of this market because it's all over the U.S. and so there's a lot of access advisors could get going to this
That
market.
is correct. And what we're talking about here are 3,000 plans that are no longer actively taking contributions into the plan. So they've been frozen in time. It's 3,000 out of 26,000 pension plans that are in the United States, all shapes and sizes, 5 participants up to thousands of participants. So from this standpoint, the snapshot that I'm taking you through here is just the frozen market. So this is kind of the low-hanging fruit for determining whether or not it makes sense for these plan sponsors to consider and maybe implement some type of a risk transfer strategy, getting the assets of that plan, moving it off the corporate books into a group annuity.
Well, the administrators of these plans, I mean, they're just still sitting there. They're not really doing anything about it. They don't have any plan or ideas. This is where we come in.
Right.
I mean, there are a lot of concepts and strategies and tactics that they could employ to really help themselves as well as move into maybe a defined contribution plan because this is a frozen plan.
There are. And I think in my experience, what I've found is plan sponsors, they know what the risks are, but they really don't know, okay, how do I deal with these? Is this just something I'm going to have forever? It's going to be in my purview to make sure that the financial investment risk, the longevity risk, the things that we've talked about and will talk about continuously, there are opportunities for them to transition away from their current status, which is, this is what it is. There's nothing I can really do with it.
Well, the climate of this market right now, I mean, we have seen in the past poor investment performance. Now, as of late, it's been pretty good.
2013, we saw a nice bounce, not only market-wise, but interest rate-wise. And again, depending on how these plans have been invested, they did see a nice run back from where they were just maybe a couple of years prior, coming out of the recession of 2008.
When I look at the lack of funding, how is that going now? I mean, do you see that still as a detriment?
Much improved from just 2 short years ago. 2 numbers I'll give you. July of 2012 was kind of the low point in the funded status of these plans on average. 75% was the average number that was quoted, which means 75 cents of every dollar of liability was funded with the assets in the plan. We came back into the end of 2013 after the market and investment performance. Now we're at a 95% average funded status. So again, that now screams opportunity for these plan administrators to look at some of the options that are available to them.
Well, I know they're adjusting their investment portfolio. They're trying to look at the possibility of transferring risk. And some are, I think they're paralyzed by the whole issue. They're just staying the course. They don't really know what to do.
Yep.
I want to look at this other section of this too, because when we're looking at funding status, the approval, as you've cited this now, you just talked about some of this here. What some of the reasons that things are happening in our market right now? We're getting this performance. I mean, 2013 and actually 2014 now has been pretty good.
Yes.
We're setting records here in May and June. Well, we'll see what happens in June, but in May, and then we're seeing a little bit of an uptick in high rates, like you've mentioned. Now, I don't know if we're going to see a lot of it or not, but.
Well, we kind of did one of these again, you know, just like any cycle. Some are better, some are not so good. I think what this lies in here is while there's been improvement, there's also the ongoing risk, especially for those 3,000 plans that I indicated where we've now frozen the benefits in time, but you know what? Those plan administrators still need to make sure their investments are going to match the liabilities on a move-forward basis because what we don't know is a year from today, 2 years from today, 5 years from today, how that's going to match and what their funded status is going to be at that point in time.
And we're looking at longevity risk, and the actuarial science of this could complicate everything we're talking about. I mean, if we're living longer, 3-4 years, and this probably is based on the 2001 CSO, I'm guessing. If they've seen the 2008 VBT tables, relative risk tables that the SOC put out, the Society of Actuaries, I mean, we're looking at some serious extension here. So That's a huge issue just on the basis of longevity. I think I have one more slide here. Yeah. And then I want to talk to you about this whole idea. You know, we're talking about the pension, the guaranteed fund.
Right. I'm
looking at 213 and 216. Talk a little bit about this and walk me through it.
This is the Pension Benefit Guaranty Corporation, which underwrites and essentially ensures the viability of pension plans. As part of the congressional budget deal in the end of 2013, within that deal was significant premium increases that plans must pay each year to the PPGC for essentially insurance of their plan. To give you a snapshot here, last year, $42 per participant was the premium for a fully funded plan. If my plan was not dollar for dollar or fully funded, I also had a variable premium component that was added to my per participant, and that's what we're talking about over here in the per thousand of underfunded assets in the plan. Is now you start to see premium increases on the low side 50% to more than 200% on the high side. That's a significant change that now administrators are going to have to deal with as they move forward and manage their portfolio and their plan.
When we come back from the break, we're going to look at this whole thing from a plan sponsor point of view, because I think that's where the game's to be played, and this is where we can come in with a solution. We'll be right back after the break.
Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company.
Welcome back to the second segment now. We're going to look at this from a whole nother view. The plan administrator and some of the things that he's confronted with. Walk us through this a little bit.
Sure. A couple of different looks here, and to kind of expand on what we talked about before the break about this increasing cost risk that now plan sponsors are faced with, is I'm going to give you an example of a pretty straightforward plan, $100 million in assets. I've circled the fully funded because that's key here, because that's going to change the numbers as we go to the next page. 1,000 participants. So last year, this plan, the way I've laid it out here, would have paid $42,000 in premium to the PPGC for insuring their plan. Moving forward, and there are going to be incremental changes. It's already part of the law. This isn't if, ands, or buts. This is happening. By 2016, this same plan, all else being equal, will now be paying a $64,000 premium to the PPGC, 52% increase. So just everything else being equal, they're looking at this change in premium of a frozen plan. Benefits have been frozen, but now their costs are going to continue to rise.
So they still have to pay the pension benefit guarantee
every year.
And now it's increasing.
Yes.
And so now the plan administrator is going, gee, you know, I just got almost back to par. I wonder if I should go on further. Oh, I got a new expense here just to admin the
and a
entire
growing
plan.
expense.
And a growing expense.
Right. The second slide is looking at this same plan, but now let's change one variable here. Let's say that this plan isn't fully funded. So instead of $100 million of assets, we have $95 million of assets. So based on that seemingly small difference for this size of a plan, look what it does to the premium costs. We still have our $42,000 for the number of participants, but now the second variable component adds in here. Last year would have been $9 per thousand of our underfunded number. That's where I'm getting my math here. So the total premium that this plan would have paid last year is $87,000. Well, we've already jumped to what the difference is here. By 2016, same dynamic. Not only has our base premium risen to $64, now we're at $29 per thousand of underfunded status, and now we go from $87,000 of expense last year, $209,000 in 2016.
Okay,
that is adult money.
Steve, when you say this, I'm thinking when some of these plans are way more underwater than 95%. I mean, we're just looking at a nickel here.
Correct.
So if you're looking at a municipality like Detroit that's been in the news, we're talking maybe 25, 30% under. I don't know what the numbers are. But that number should be huge. That means that they're paying these kind of actually insurance premiums, basically, to the PBGC. So this number has to be one of the tipping points for an admin, a person that's looking at this and saying, it's time not only to freeze this program, just to kind of maybe get, start all over again.
And if it isn't a tipping point, it should be. So what I've taken on, again, in my experience, in laying out some of these additional risks that the plan administrator may or may not be aware of, that often is one of the things that, oh, we can't have that. We,
Right.
we have to find a way around that.
When you stand in front of these people, Steve, is this the first time they're seeing these numbers?
In some cases, it is.
So this is really a shock and awe first contact experience with some of the plan administrators. They're looking at serious money here.
Big money. More often than not, if we're dealing with maybe the plan actuaries, they're going to have a little better idea because, again, as these new laws have come into focus, they understand it. But plan administrators, by and large, do not.
Yeah, now that it's time to act. That would be the understatement slide that we have for the whole
Exactly.
show. They have these choices. Let's just walk through some of these because we want to give everybody an alternative and basically a call to action.
Right. We spent enough time on the challenges. Now let's talk about the opportunities. And again, from the plan sponsor point of view, really the four major options that administrator has, whether it's an active plan or a frozen plan, is take a look at your funding status. What can be done from an investment mix standpoint to narrow that gap, especially for plans that are currently underfunded, because we're seeing the costs in the previous slide. So what can we do here? Offering lump sum buyouts, sometimes segmenting portions of the plan, maybe offering lump sum buyouts to maybe your terminated vested participants in the plan, or maybe segments of your retiree segments of the plan to cash those out, which now kind of reduces, again, some of the potential liability on a long-term basis. Discretionary contributions is something it's come more into play now. Basically what that is prepaying some of those PPG premiums now in the hopes of keeping your gap and your costs within line. And then lastly, risk transfer, looking at maybe this is an opportunity to say, what will it take to move that asset, that plan, off of the company books into a highly rated insurance company, and now they have the risk of managing the plan moving forward.
Are there any restrictions when you do go to the annuity platform as a risk transfer issue from a product point of view? Can I use any kind of annuity? I'm assuming variable would be out.
Variable generally is not used. You're basically looking at fixed group annuities. The short answer to your question is it's not an off-the-shelf type of a product that we're using here. This is something that is uniquely priced for the specific plan that carrier is looking at. So we get all the dynamics of the plan. Basically, it goes into the grinder of the insurance carrier, and then they are pricing. And basically, it's a unique product specifically designed for that.
Customized annuity.
Yes.
Price of that. And
No two are the same.
But it's not a security.
It is not.
It is not. So any of our advisors who are not FINRA licensed could also look at this and sell this.
That's correct.
That's a huge opportunity. Here are the four issues. I think you found this to be fascinating as I do. That's all the time we have for today's show. Remember, before moving forward with any of the ideas you hear on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance department. Missed an episode? Just hop out to our site, downtobusiness.ashbrokerage.com. And remember, you could be wiser. That's an Ash Brokerage Advisor. I'm Steve Savant. We'll see you.